On July 31st, Maruti Suzuki India announced that its board had approved the acquisition of the entire stake in Suzuki Motor Gujarat from Japan-based parent Suzuki Motor Corporation. Suzuki Motor Corporation currently owns a 100% stake in Suzuki Motor Gujarat, which supplies its entire production to Maruti Suzuki. The acquisition is subject to all legal and regulatory compliances, including minority shareholders' approval. The board has also approved the termination of the contract manufacturing agreement with Suzuki Motor Gujarat. The decision over the mode of acquisition and consideration to be paid to Suzuki Motor Corporation will be decided in subsequent board meetings. The auto major expects the transaction to be completed by March 31st, 2024. India's auto industry is growing and has export potential. With the acquisition, Maruti Suzuki says it aims to increase its production capacity. To meet its carbon neutrality requirements, the company said the production capacity for drivetrain technologies like EV, CNG, and ethanol, among others, needs to be augmented. Maruti Suzuki is focusing on consolidating all its production and production-related activities under a single management. So, let's understand from Dilip Chinoy the rationale behind the company's acquisition move.
I think when you were looking at 2014, right, the capacity utilization of that plant was not significant. So if as a company, the investment would be very heavy and the capacity utilization low and it would impact profitability and impact your books. You have a completely operational plant, right? And you are still looking at contract manufacturing, and the way it is done is, doesn't give you the flexibility, doesn't give you the ability to change product mix, even though there is some joint shareholding in both the companies. So it makes sense for Maruti to look at this. If they're buying the plant, we don't know what Suzuki is going to do with the money.
The move comes amid a profitable first quarter for Maruti Suzuki India. On the back of car sales recovery and easing supply chain disruptions, the company reported a jump of 145% year-on-year in net profit in the quarter ending June 2023, sitting on a massive cash reserve of more than 45,000 crore rupees. As of April 1st, the company has been focusing on manufacturing expansion for some time. In April, Maruti Suzuki India announced its plan to set up a new plant in order to increase its annual capacity by 1 million units. Another plant in Kharkhoda, Haryana, is expected to boost production by 1 million units. Chairman R.C. Bhargava had also stressed that the company would not resort to borrowing for expansion, but use its internal resources. After the announcement of the acquisition, Bhargava told journalists that the production, cost, and profits of Maruti Suzuki India will not be impacted. But what makes Bhargava so bullish on this acquisition?
So supposing you were to take the dynamics of it and you're producing a car for 100 and the outsourcing cost is 80, right? And you're doing 300,000 cars a year, right? If you do 300,000 into 80, if any cost of the plant is less than that, then obviously it's not going to impact your balance sheet, right? There will be a cash flow issue and there will be another issue, right? So the deal structuring will be quite important.
The commercial contours of the transactions are not fully made public. They'll take some time. I think it is not just the payment for buying the plant, but also the value created in having integrated manufacturing within Maruti, which one should evaluate. So you cannot just evaluate what's going out in terms of the current payment. We should also, over time, over year after year, the additional value added because of that manufacturing plant into Maruti shareholders' value creation. That should be evaluated together.
However, in 2014, Maruti Suzuki India had defended the plan that the Hansalpur, Gujarat-based Suzuki Motor plant would be owned fully by Suzuki Motor Corporation. It faced backlash from investors and other stakeholders who feared that Suzuki Motor Corporation would own the plant and sell cars to Maruti Suzuki India on its own terms, turning the latter into a mere marketing arm. Bhargava had defended the decision back then, saying the cash reserves of Maruti Suzuki India, which were over 7,500 crore rupees fetched 8 to 9% return as interest. This interest income would have come down if Maruti Suzuki India had funded the Gujarat plant out of its cash reserve. Meanwhile, Suzuki Motor Corporation was earning only 1% interest on its cash reserves of 25,000 crore rupees in Japan. So, the investment would enhance their returns, he had said. Bhargava had portrayed the deal as a win-win for both companies. So, what has led to the apparent change in stance by Maruti Suzuki India now?
At the time when they did into this contract manufacturing arrangement, see, the cycle of the automotive industry was declining. Now, what has changed significantly is that the Indian market is growing. They also have a stated objective. They always want to be, above 45, close to 50% of the Indian market. And therefore, they're entering into new segments, right? And looking at different aspects. So the circumstances have changed, right? Remember, Maruti are very frugal companies. They compete at the lowest end of the market, right? I don't believe it's a reversal of stand. The circumstances have changed, so it makes sense to do this now.
In 2014, I think the environment that time was different. Maruti had not come up the curve in terms of exports. Maruti also had various challenges at that point in time. And today the things are very different for Maruti, at least in terms of business perspective. They need to now increase their capacity to meet with the demand of the product. And they need to take charge of the production much more than any time before.
Meanwhile, at the bourses, Maruti Suzuki's share ended 1.2% lower on Tuesday, as the company's operating margin weakened in the June quarter. Investors also factored in a reduction in the earnings per share due to possible equity dilution for the Suzuki Motor Gujarat deal.
The Gujarat plant, after generating cash flows from Maruti, increasing the capacity to about 7.5 lakh units per annum, creating value, is now being sold at over 12,700 crores to Maruti itself. Shareholders surely are not happy with this development, as it would reduce the EPS as well as return on capital employed. This may weigh on the stock performance from a short to medium-term perspective.
Experts are of the opinion that the acquisition will prove beneficial for the auto major. The streamlined management of manufacturing is expected to give greater autonomy to Maruti Suzuki India in terms of production capacity and carbon neutral goals.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's moving from employee to employer. Business Standard.